Welcome to Far From Wall Street. This is Michael McCall for Tuesday, January 16th. So here's what we're seeing. In December, inflation dropped again while retail sales continued to roar. Growth with almost no inflation is an optimal condition, rare in modern U.S. history. Meanwhile, earnings growth is accelerating, and earnings drive stock prices. Now stay with me here. This will make sense. Drilling into the retail sales data, non-store retailers, online sellers, grew explosively in 2017, soaring 12.2%. Take a look at this. Dominated by Amazon, online sales have transformed the way American consumers spend, dominating sales while department stores and traditional retail outlets are shuttering locations. For example, even as Walmart was boosting its minimum wage to $11 last week, it announced plans to close 60 brick-and-mortar Sam's Club big box stores. The truth is, job losses in department stores and other traditional retail locations have been more than offset by new jobs at online retailers. Moreover, retail sales, excluding volatile gasoline, grew 50% faster in 2017 than in the last expansion, and more strength is in the pipeline. In the next month, new low tax rates will boost paychecks. Consumers will get a lift in net income and have more to spend, which is key to our economy. A company's earnings are everything. The earnings picture is bright. Since April '91, when the decade-long expansion of the 1990s began, profits at large American companies have grown at an average annual rate of 7.4%. And a dollar invested in the average company over this 26-year period averaged a 7.4% total return annually. Projecting a continued earnings growth of 7.4% would put prices on the trajectory indicated by the black dots. However, earnings growth is expected to be much higher than 7.4% for 2017, 2018, and 2019. Earnings growth of 11, 12, and 10% is what's expected. This explains why investors in recent months have bid share prices higher consistently. At 103 months, this cycle of expansion is the third longest in modern U.S. history, behind the 120-month boom of the 90s and the 106-month-long expansion of the 60s. This growth cycle could set a new modern record, but you never know what's going to happen next. In a speech last week, the nation's number 2 central banker warned that the newly enacted tax law poses risk to the creditworthiness of the nation. William C. Dudley, who recently announced plans to leave the Federal Reserve Bank in May after running the influential New York district for 8 years, shared his static accounting point of view by offering a contrarian view, saying that the Tax Act's near-term benefits ultimately could damage faith in the credit of the United States. Mr. Dudley, a key architect of Fed interest rate policy after the financial crisis and mindful of his legacy, bluntly told a gathering of Wall Street executives that, in his opinion, the current fiscal path of the nation is unsustainable. Okay, reality check time. Despite the political sideshow in the media, the S&P 500 closed the week at a new record high once again. Yet plenty could go wrong. Rapid acceleration in growth from the new Tax Act increases the likelihood of the Fed making a mistake in interest rate policy by hurting growth or allowing the economy to overheat. A political surprise, the nuclear standoff with North Korea, and unspeakably nightmarish events may seem more imaginable than ever. Realistically, a temporary drop of 10 or 15% could occur in a flash of bad news, and the chance of a bear market prolonged decline of 20% or more increases as the 8.5-year bull market grows older. But the economy shows no hint of recession. To the contrary, government headwinds have turned into tailwinds, resulting in robust earning growth that is expected for 2017, 2018, and 2019. And that's literally the bottom line. As always, please contact my office with any questions or to set up a meeting. And don't hesitate to share this video with friends who might benefit from my work. Remember, it's great to be rid of those commission salespeople, and it's great to be far from Wall Street.